Is this the end of affordable property in Australia? In September, prices rose 0.8%, with a national median of $857,000. Who would have thunk it? The value of Australian real estate has just topped $12 trillion. Trillion. With a T. On top of that, supply is collapsing. The government has missed their target. Approvals are down 6%, and units are down a third. Units. Most people don't even want to live in units. Build some more bloody townhouses. We're the missing middle. I've bought $55 million worth of real estate for clients, as well as over $7 million worth of real estate for myself. And I see that the biggest risk right now for investors or for buyers is buying based on price alone and not based on potential or potential for growth, more importantly. So before you buy, you need to understand how affordability actually impacts long-term growth. So today, we're going to talk about what's happening to affordable property. We're going to talk about the warning signs that are separating an opportunity from a trap. Well, not a trap, that's a bit hyperbole, but you know what I mean. One of the biggest misconceptions I see people make is they think that cheap equals good. Cheap equals growth. Cheap equals good rental return, good rental yield. But cheap doesn't mean any of those things. Cheap just means cheap. So yeah, you can always find cheap property. It means nothing. The goal is affordable property and growth, not affordable property and flat or negative. That's certainly not what we want, because cheap property without growth is just a liability and is costing you a huge amount of opportunity costs. So shift your mindset. Stop thinking, can I afford it? And think from the lens of, will it grow? So now that we've established that, we now know that not all affordable property is created equal. People often think, oh, I can't afford a capital city, so I'll go regional. But it's just not as simple as that, right? There are huge implications as to whether you buy in a capital city or you buy in a regional location. We typically tend to find that capital cities have a stronger long-term compounded growth rate. There is more stability, there's more population growth, infrastructure, higher wage growth. All of these things are really, really important considerations. While capital cities might not have the yield or the cash flow, they usually tend to outperform in the long run when it comes to capital growth, which is the thing that's going to make you wealthy, by the way, not your rental yield. That's not to say that regional purchases aren't a good idea. I own regional properties in my own portfolio, and they act as a really good balancing tool for your portfolio to add to your asset base with a little bit of growth and not too much out-of-pocket expenses. But you can only really do that when you have a bunch of properties already. You don't want to be buying a regional property as your foundational asset, unless, of course, the plan is to expand into capital city assets immediately after. Because as I just alluded to, affordability performs differently across capital cities, semi-regional locations, and fully regional locations. Capital cities give us higher prices, stronger economies, and usually better long-term growth patterns. Semi-regional spots can actually be a sweet spot. A nice little in-between where you have the spillover or the halo effect from cities out to these semi-regional locations. Think Central Coast or Newcastle, think Geelong. All of these places are semi-regional because they're maybe 1.5, 2 hours from a major capital. Now, proper regional might be cheap, but you're probably going to have slower long-term growth, not short-term. You can have big spikes in the short term, and slightly higher risk. And that risk can come in multiple forms. A lot of the time, it can come in a single industry town risk or a centralization of industry risk. Take a mining town or a tourist town or things like that represent just a higher amount of risk. Because property investing, ladies and gentlemen, is all about your risk appetite. What risks are you prepared to take? Are you prepared for socioeconomic risk? Are you prepared for the risk of buying a really expensive property and the risk that puts on your cash flow? Because that's still a risk. Are you prepared for flood, fire, and climate risk? Or are you happy to mitigate that with insurance? Like, risks are all part of the game. You just have to decide which ones you're comfortable with. And like I said, if you're investing in a capital city and a location that doesn't seem to have much risk at all, well, then look again. The risk is probably your own cash flow and your own financial position, because it's probably stretching you a little bit more than you ideally wanted. There is always risk in property investing. Anyway, let's get back to it. The key question you've got to be asking yourself here is, what am I trading off by investing here? Wherever it may be. If you want, I've got something that could help you out. I've got a free warning signs guide. You can click it. It's down below in the description. Now let's talk a little bit about the relationship between socioeconomics and location. This is an interesting topic. People often think capital city is just by default good and regional is just by default risky, but that's not always the case when you peel back the covers, when you pull back the curtains, when you peel back the layers of the onion. And I'll give you a great example. I've bought a lot of property in Cairns. I've bought for myself and I've bought for other buyers too. Represents a good balance of yield and growth. It's a regional location with a good lifestyle. Will it underperform my capital city assets over a 10-year period? I assume so. I've factored in a 4 to 5% compounded growth rate as opposed to 6 to 8% for my capital city investments, maybe even a little bit less. But one of the interesting dynamics that you'll find when you buy in these regional locations is, versus say a capital city, is that when you go and buy for say $600,000 or $650,000 in a regional location, you could actually be buying in one of the best socioeconomic pockets of that regional location. Whereas you take that same $600,000 and you go and invest it in the western pocket of Melbourne, for example, right? Or the northwestern pocket of Melbourne, and you're getting the bottom of the barrel socioeconomics in comparison. So there is a little bit more inherent risk there. But the trade-off is this: you should be getting a stronger long-term compounded growth rate in a capital city than you would in the regional town. But again, there is that trade-off, especially if you only have a number like $600,000 to spend. But that's not to say that those lower socioeconomic areas in, say, Melbourne will underperform that of a higher socioeconomic area in a region. I don't think it will. And that's because of big city infrastructure, you've got population growth, you've got a lot of economic diversity, and you simply just have more people competing for the same stock, which drives up prices. So the lesson here is that the location type is only part of the equation. The socioeconomics, the supply and demand indicators, and the economic diversity play a huge role and are often the real drivers of demand. So ask yourself, what is driving the growth here? Is it sustainable? What am I expecting from this location or from this property in terms of its long-term growth? If you're expecting capital city returns in a regional or super regional location, you're kidding yourself. You might get that for a 2, 3, 4 year period, but the likelihood is that location will go flat, maybe even negative for a period of time. So my advice is have a portfolio that's balanced, but you need capital city assets that you can draw down on equity that will build equity consistently over time. And you want those regional properties in there to balance out your cash flow, still grow, but you don't expect as much from them. Now for the hard truth. Affordable property in strong locations is disappearing fast. People think that, when rates go back up or when there's a correction or a downturn, prices will come back down. They may, but you're probably wrong, and I'll tell you why. If those locations in 2026 see a 10, 12, or 15% growth cycle, which they very likely will, if there is a correction or a downturn, your best case scenario is the prices are coming back down to where they are today. They are not going to do some astronomical or crazy plummet or crash that is going to wipe out prices. And that is because property is a few things. One, it's very illiquid, as in a crash doesn't happen overnight. It's very prolonged, happens over a 12-month period because it takes you a long time to sell, a long time to get your money. Not like the stock market where you go on your phone, you go sell, and overnight the market can crash. The other thing is that property has utility. So if you're buying in locations that have good owner-occupied demand, they're 60-65% of the people buying property. And those people aren't selling their home when they're in strife. They're going to sell their investment properties. They're going to hold on to their home for dear life. They'll be living on sourdough, actually not even sourdough. They'll be living on Wonder White and rice, certainly not avocado on sourdough, until they can recover. And they're not going to sell their home, I'll tell you that much. Quality areas don't just get cheaper. They might go like this, then they come down like this during a correction, but they're just going straight back up. And the reason being they get snapped up by investors with capital or first home buyers that have got family support and by people that are upgrading their properties. So the best affordable stock gets snapped up. And then what's left? Just the cheap, affordable stuff that maybe pays you a good yield or a good cash flow return, but it's not going to grow. It's not going to give you what you need to build equity, to become work optional, to generate yourself a passive income, or to retire early. And don't sit there and wait around for the perfect affordable property, because while you're doing that, prices are going up and good quality assets are getting bought up by the day. Comprende? Okay, on to the next. So let's talk about some of the red flags that kill growth. Please, for the love of God, hear me. Cheap and good yield doesn't mean safe. It doesn't mean good. This idea of your property paying itself off is only good if it is appreciating in value. Otherwise, you are losing hundreds of thousands of dollars. Do you hear me? You are losing hundreds of thousands of dollars in the short to medium term. In the long term, you're losing millions. Ask yourself why it's cheap. You just don't want cheap for the sake of cheap. Believe me, you will be looking back at it in 3, 4, 5 years and going, oh, gee, I could have bought this or I could have bought that, or it's really underperformed. So let's talk about some of these red flags. Number one, single industry towns. Don't get caught up in a location that is dominated by one industry, or the centralization of industry risk, as we say. The reason being is because if that industry or that market or whatever it is that space is tanks, or has a period where people don't have work, and they buzz off from that town, they fly home, all the money disappears, all the demand goes away. Supply might have been tight, but if the demand disappears, all of a sudden, there's more than enough supply to meet the demand. You end up freaking out and selling for a major discount, and at that point, you might have lost money. So don't do that. Number 2, hotspot or the hype towns. Unless you want to be playing the equivalent of day trading, maybe call it year trading in the property market, don't go and buy in a hotspot. Again, unless you're prepared to hold on to the asset for 2-3 years, get a lot of growth, and then sell it. But the question then becomes, how do you know when to sell it? Could you be left holding the bag if you don't pick the time to sell properly? Or would you rather just buy and hold long-term investments? That's what I like. But yeah, the reason why those markets are risky is because investors tend to pile in. They skew the owner-occupier to renter ratio massively. So there's a huge amount of renters or landlords that are buying in an area. Once those investors have made a lot of money, they've realized their growth, top of the cycle, they all start to sell their properties, and all of a sudden supply floods the market and prices can tank or go flat or then tank, whatever. You don't want either of those things anyway. Number 3, low socioeconomics can be really risky, especially in these affordable locations. Because if you're buying in an area where the average renter or tenant is the opposite of well off and is going to struggle to make their rent, or is going to get kicked off of benefits, or even if the homeowners in that area lose their jobs, what is going to happen to supply? Well, there is a risk that supply will increase. People need to sell their homes. Renters can't afford their rent. These are all huge issues with really low socioeconomic areas when the rest of the data is not checked off properly. I don't mind low socioeconomics so long as the other data points do stack up. But it's just something to be really wary of. Number 4 is buying into a location at the top of its cycle. These are the markets that have seen 60, 70, 80, 100% growth in a 4 to 5 year period. So they've almost doubled in a 4 to 5 year period. The problem with these areas is that even though they might still be affordable, usually towards the back end of a growth cycle, investors are absolutely piling in. So it relates to one of my other points, but the reality here is you don't want to be in at the end of a cycle because the likelihood is the growth will not continue in the same way it has in the last 2, 3, 4, 5 years. And even if it does, it is investor-led, investor-driven. The owner-occupiers have more than likely started to fizzle out, which makes for a very dangerous and high-risk dynamic in that market where you are playing in a market that is essentially not being invested in or bought in because people want to live there, but because people want to invest and make money, which is risky when it comes to a potential future oversupply. So if you find yourself hitting any of those 4, walk the other way and be very, very wary of those markets. If you're interested, if you want to hear more, if you want to talk to me, you can book a free strategy call. I'll show you exactly how I avoided all of these red flags for my own portfolio and how I do the same for other clients. Chat to me. I'm a decent bloke. To build a real portfolio, you need strategy, you need timing, and you need to take action. But strategy is nothing without cash flow. Oh, JP, you always say cash flow is not important. No, I never said that. I said capital growth is the game. Cash flow keeps you playing it. So it is important. So in the next video, you will be able to see how I make $17,000 a month from my property portfolio. And I'll talk to you a little bit about how growth is great and is definitely the pinnacle, the most important thing. But cash flow is what you need to manage and will ultimately give you freedom in the long run. But growth first, don't forget it. See you on the other side. Toodaloo.